We'll get started. Okay, first and foremost is to get the disclaimer out of the way. Nobody's told you can make $3 million in 2 weeks, and possibility exists you could sustain a loss in some or all your investment. Therefore, you should never invest money that you cannot afford to risk. If you have any doubts, please seek an independent advisor. Okay. All right. If you could hold your questions to the end, because most of the time we do answer the questions, and then we don't have to stop and slow the webinar down for those questions. Um, if you're going to call these the greatest charts in the world, when you make a statement like that, you better be able to prove it. So this webinar is about proving to you that exactly what we say, there are no charts like this in the world, and they will definitely, definitely help your trading. So let's talk a minute just about limiting your risk. If we assume a probability or a possibility of a win or a loss on any one trade being 50%, 50% of the time you win and 50% you lose, that means that if you risk 50%, you will wipe out as soon as you have 2 consecutive losing trades. But you have 1 chance in 4 of that happening. If you risk 25%, you will wipe out as soon as you have 4 consecutive losing trades. And you have a 1 chance in 16 of that happening. If you risk 10%, you will wipe out as soon as you have 10 consecutive losing trades. And you have a 1 chance in 1,024 of that happening. But if you risk 5%, you will wipe out as soon as you have 20 consecutive losing trades. But you only have 1 chance in about a million. And if you're risking 2%, you will wipe out as soon as you have 50 consecutive losing trades. But you only have 1 chance in about a billion. So somewhere between 2 and 5% is the correct level that you should be risking when you're trading. And that's going to become important in just a minute, okay? If we polled everybody in the call and said, have you lost 10 trades in a row consecutively, virtually everybody would say yes, they have. So we can see that 10% is too much. And it's one of the biggest problems that traders have, is that they over leverage their margin account. So besides over leveraging, the biggest problem is that traders cut their winners short and they let their losers run. And I'm going to show you what that does to you here. This is an Excel spreadsheet that we've made to show this kind of thing. And over there on the right, you can see that we're talking about 30 pip stops. Now, that's not a set in stone 30 pips. The average at the retail level is around a 30 pip stop, but it could be 37 on this trade, 42 on this one, 26 on another, but on average 30 pips, okay? The average retail trader in the marketplace trades for 5 pips. That's the average win. I'm not the one who says that. That's what our brokers say. The average winning trade for a retail trader is somewhere between 5 and 8 pips. And the problem with that is very simply, with 30 pip stops, you now have to be correct 90% of the time for the rest of your life. 90% of the time. Now, on our charts, we have some interim targets built in, and they're called T30s, and they are 30 pip targets. They're provided by the software. Now, with 30 pip stops, if your average trade now goes to 30 pips, you will break even at 50%, which means at 51% you will have an increase in your margin account. In other words, you can lose 49 trades out of 100 as long as they are not consecutive, and you will have an increase in your margin account. But on our charts, we also teach you to trade for the first trade of the session to be 55 pips. And we do everything we can to teach traders to trade for 30 and 55 plus pips. At 55 pips, you will have an increase in your margin account if you can trade at only 40% of the time. In other words, you can lose 60 trades out of 100 as long as they're not consecutive and still have an increase in your margin account. So, knowing this, let me go back to the PowerPoint and Our charts, ProAct charts, were created to solve this problem that the vast majority of traders have. All right, so what we did was we took a different approach. We look for harmony, and we created software that finds harmony in the marketplace. We then look for momentum. We knew one thing, that the big boys enter when the charts are lined up, or in other words, there's lots of harmony in the charts to make a move. And that's when the big boys come in. And when the big boys come in, they create momentum. And momentum is something that we have been able to capture and visually show on a chart. Now, we then look for the big boys' targets, and we do everything we can to stay in to the big boys' targets. Now, the names of our setups are due to our history. We were a group of traders who, like most people, struggled in the early years. And about 4 years ago, we all got together, we rented a room, locked ourselves in, and we put 8 laptops up, and we set about to create some charts, initially only for ourselves. And we rented a place on a street called Poker Alley. And we live in Texas, and this is actually the place where the cowboys used to stop, and they would play poker on their way to driving the cattle up to Kansas City during the the cowboy days. And because it was located on Poker Alley, when we designed these trades, we had to have a way to differentiate between the different setups. So being on Poker Alley, we naturally called them by poker names. We never intended to be in the chart business. We intended to create charts for ourselves. That's all we ever wanted to do. So the names that you're going to see of these trade setups are named after wild cards, 6 aces, royal flush. They are poker names, and they're named because of our history, not because we are gambling. So without any further ado, let's take a look at these awesome charts and see what we're talking about. Now, the wild card is the first trade I'm going to show you, and the wild card setup is on one screen, so we will look at that trade live. But it takes too much time to reset the 6 aces and royal flush because they are multiple screens, so I have screenshots of those. So let's just go take a look at the wild card here. All right. So this is the wild card. And you can see that there are 9 currencies side by side. So we're just going to simply open up a currency. We'll take the euro because most everybody likes to trade the euro. And we're looking at a 10-minute chart here. I'm going to wait till it shows up here. There you go. All right, so we're looking at a 10-minute chart. However, the only thing on this chart that comes from the 10-minute is the candle itself. Nothing else is from a 10-minute chart. This moving average that you see right here shows the trend. It actually comes from the 240, and it shows the trend on the 240 chart. Okay, the green thick line down here is the fast moving average and comes from a 60-minute chart. The 2 moving averages that you see here is over here the little thin ones are red going down, over here they turn green going up. Those come from a 30-minute chart. Okay, so you'll see also there's several other things. There are these little horizontal lines. Looks like a grid to you. They are actually, that looks like a grid, but it's not. It's actually an algorithm that's running off the pivot point off of a day chart. And every session, our software calculates how much of the pivot point has been taken out and recalculates the new targets. All right. Now these are 30 pips apart. We call them T30s. Okay. So when you get a signal to take a trade, your next trade target is 30 pips away. And you can see that the market knows right where they are, and it comes right down here to this T30 right in here, bounces on the T30, back up to this T30, up to this T30, back down, up over here. We're over on the T30, run along the T30 here continuously. So the market knows where they are. Why? Because it's a real number that the big boys use off of a day chart. You and I can't trade a day chart because we don't have all the money in the world. So these little horizontal lines are called T30s, and they are 30 pip targets, and they are extremely important because they are interim targets. They are not the big targets, but they are interim targets in the move. There is no move that can start and go directly to the target. They always take a circuitous route, and these are the places in the market where the market will stall. It'll reset, it'll retrace, whatever. So those are very important places in the marketplace. The other thing you'll notice on this chart is we have white dots, okay? You also know that we have arrows and painted candles. Now the arrow here, in this case the green ones, let me make this a little bigger so you can see it. And I'll just pop it up here to make it a little wider. You can see that these arrows here show up, and they're nice to see. What they mean is money is coming in. Okay, that's all they mean. Money has entered the market, and we get them both ways. And because we are momentum traders, we only trade when there's the highest probability of momentum in the market. When is that? The first 2 to 2.5 hours of a market session. If it's the London session, the first 2.5 hours. If it's the New York session, the first 2.5 hours. And if it's the Asian session, actually the first 2 hours of the Asian session. After that, we don't trade, okay? Because it takes billions of dollars to create an arrow during the openings of market sessions. It does not take a lot of money to create an arrow in the afternoon sessions or the time between the markets, okay? So we trade momentum. So the arrow tells us money came in. Now, the candle, if it can change color, okay, into bright green going up or bright red coming down, that means that behind the scenes, we have 24 indicators. All the indicators that you're probably using now, but we have 24 of them. And it took us 1.5 years to fine-tune those indicators so that they would cross and all go into a buy or go into a sell. And the key was momentum. Is there enough money coming into the market to not only tell us that money's coming in, but most importantly, is there enough money to turn 24 indicators into a buy or 24 indicators into a sell? If that's the case, now we are very interested in this trade. All right. So the other thing you'll notice is the white dot. Now, what is the white dot? The white dot is an arrow and a painted candle on the 60-minute chart. And why do we watch that? It's because the big boys trade the 240, the day, the week, and they place their entries on the hourly. If you read commentaries by multiples of places in the forex, you're going to read things like the hourlies are overbought, the hourlies are oversold. Why is that important? Because the hourlies are where the big boys place their trades. So when we get a dot, that tells us that the big boys put money in at the 60-minute level. In other words, an arrow and a painted candle occurred on the 60-minute chart. Massive amounts of money has entered the market, either in a buy or a sell. Okay? So we have specific rules for this, which we'll go through in just a minute here. The other thing that we mark on this chart are two other things. One of them is we mark the moving average crossover. That's this line right here, okay? And you get multiples of them. We mark this thing for you, but we don't teach people to trade a moving average crossover. We all learn moving average crossover systems, as have most of the people who've traded the forex. And what we found was that moving average crossover systems are late when it comes to momentum. We got really tired of entering on a perfectly good moving average crossover, have it stop dead, turn around, come down here, pop our stop out, and go right where we thought it was going. All right? So we mark it. And what it tells you is that if you're already in this trade, and you can see we had an arrow and a painted candle down here, we'd already be in this trade up about 20 pips by the time the moving average crossover occurs. Now, if you're in the buy, and a moving average crossover occurs, that means that the rest of the world just got their buy signal. There is no reason for you to exit a buy position when the rest of the world just got their signal to enter a buy. And so we mark it so that you will stay in the trade. The next thing we mark is the MACD crossover. And the MACD that you see down here at the bottom comes from the 60-minute chart. We want to see what the big boys are looking at. All right. When the MACD crosses over the zero line, that's where these little bars are called histograms. When they cross over the zero line and start trending above the zero line, that's your official word on the 60-minute chart that you are potentially trending up or down, whichever way the MACD crossover is. And so there are not a lot of people who want to be sellers if the MACD is in a buy. Conversely, there are not a lot of big boys who want to be in a buy if the MACD is crossed over down. All right, and MACDs are not, they're just part of the trade. They're not part of how we actually set up. We just look at them. As you can see right here, we had a MACD crossover and a moving average crossover here, and the market never went anywhere. That's the problem. We get so sick and tired of having these kind of crossovers, which was the systems we were trading, which is more than likely the systems you are trading, and getting whacked on these kind of things right here. And so we had to find a place to find momentum. You'll see that we would have gotten in up here. The arrow tells us money's coming in. The painted candle tells us that 24 indicators are in a sell. And the other thing that we mark is this T3. This is a trending indicator, but we put a T3 on here because, as you can see, it creates support and resistance. It gives you an opportunity to add to a position. If you're in the buy, it comes down and the market respects the T3 and turns and goes up, which it does lots and lots of times. That's another place where you can enter an additional position. So that's how the wild card shows up, and there are multiples on it. Let me go take another look at another chart here. We're actually, it's pretty slow today because of the non-farm payroll is this week. But here's let me put it to a 10-minute chart here. So here we can see we're looking at the pound yen right now, okay? And we can see that the trend is up. We don't have to put a trend line on here. The trend is up. This is the 240 moving average, and it tells us the trend is up, okay? Let's just scroll in the back here where we had, kind of everything that we need to make a trade here, okay? First thing we do is we need the dot on the bottom if we're going up. The dot tells us the big boys are entering the market. And the big boys are entering in a buy if the dot is on the bottom. They're entering in a sell if the dot is on the top. That's all it means. Money is coming in and momentum has entered at the 60-minute level, okay? Now, for us, we trade once we have the dot. We trade when we have the arrow, tells us money's coming in at our level, and the candle turns. You can see the candle here. Let me make it a little bigger here. And you can see, let me hold on just a second till it refreshes. There we go. You can see the candle before this dot has a black outline, okay? All right? And it's not really painted that bright green, okay? And then we get the dot. And then we get over here, we get an arrow and a painted candle. So this would have been our entry. The trade setup tells us that. The other thing we have to be is above the moving averages. That's why these moving averages are here. When we're above the moving averages, we have more buyers and sellers. If we're below the moving averages, we have more sellers than buyers. And the area that's in between the moving averages, we call the desert. It's an area that we're not sure. If you're above the moving averages, you know you have more buyers than sellers. But if you're in between the moving averages, you have no clue. And we have a separate trade setup, which I'll show you a little later, called a 6 aces, that allows you to trade in the desert, which is a transitional period for the currency. So we need to be above the moving averages. We need a dot that tells us the big boys are in at the 60-minute level. We need an arrow and a painted candle, and in we go right there, and we take that trade. It's only worth about 50, 60 pips. That's all, okay? So the other thing is, here's the moving average crossover. That tells you stay in this trade. It is potentially sustainable. Everybody in the world just got their buy signal. So don't exit the buy that you just got in. Now we have a MACD crossover. That tells you don't exit this trade. Try to stay in this trade to the targets. I'll show you how to find the targets a little later. So what we can see is that we have on one chart all the confirmation that you need to make great trades, okay? And all these, we have the 9 currencies, and you can add more if you want to. All right? So let's go back here now to the PowerPoint for a second, and I want to review these where it's easy to see. on a static screen here so that we understand how this works. As we can see up here on the top, the red moving average tells us what the real trend is. The real trend is down. So any up movements are just movements to get up higher to go down. That's all they are, okay? Now, the next thing we need to be is step one is we need to be coming out of the desert. That's the space between the two moving averages. If we can get out of the desert, now we know we have, if we're going down, more sellers than buyers. If we were going up, we know we have more buyers than sellers. That stacks the deck in our favor. Okay. Now, the next thing we have to have is we have to be above or below all the moving averages. So in this case, we're going down, so we have to be below every single moving average that's in here. All right. Now, the next thing we need is we need a dot on the top telling us the big boys have entered. And there's the white dot saying the big boys are here. They have just shown up. Now, we need an arrow and a painted candle, which actually happened 10 minutes before the dot. Okay, and so we now already have our buy signal. We have our dot, which gives us the confirmation to go ahead and trade, and we would enter on that candle right there, and down we would go. Now, here's the MACD. It's nice to see it. It's not part of the trade, but it is nice to see that it is also trending down. It will help give you confidence to stay in, so that you don't do what most new traders do, which is click out for 5 to 8 pips. You have to learn to trade for 30, 50, 100 pips, because if you don't, you have to be 90% correct for the rest of your life. Now, when you are trending, you will see that the slow 60-minute moving average and the fast moving average from the 30-minute trend together. That tells you, that's a very visual sign that you are trending. Stay in these trades if you can all do it. So that's very simple how that trade works, okay? Now, let's talk about trading in the desert. Okay, you're going to go into the desert. That's a space between the moving averages. Okay, that is a place where we don't know if we have more buyers than sellers. We have a currency in transition. We don't know if it's pulling back. We don't know if it's retracing. We don't know if it's reversing. We don't know any of that information. So we need lots of confirmation to be able to trade that. All right, so here's the 6 aces trade. I'm going to put it up here on the screen. And I want to show you, again, our job is to look for harmony in the charts. That's what we're looking for, and it takes this many charts. This is the setup. This is the way it comes. It comes just like this. When you open up the currency for a 6 aces, in this case the pound, yen, 6 aces, all these charts load for you. Okay, and the first thing is over here on the right hand side is the 240 chart. Now if this is a reversal, we don't need the 240 chart because a reversal always happens inside the 240-minute candle. All right, but if it's not, then we have to have it. But what we have to have is on a reversal is the 60-minute. Now you'll notice something here. Up on the top there are these two green solid lines. They're called HMIs. They are horizontal momentum indicators. And what they indicate is there any horsepower in the market to drive this currency. In other words, are the big boys here? If these are black, that means they're neutral. If they're green and the candles are green, that's harmony. Okay, if we were looking at the 240, and you can see we're in disharmony here because we have two momentum indicators pointing down, and we have a green candle. So at the 240 level, we are in disharmony. But if it's a reversal, then that's okay because a reversal will happen inside a 240 candle. All right, so we have to have the 60. It's very simple, green and green. Okay, now the next thing we have to have is we have to have the arrow and the painted candle. Once again, the arrow tells us that money is coming in. The painted candle tells us that 24 indicators behind the scenes here have turned into a buy. Why don't we show you 24 indicators? Because that's information overload and you would not be able to trade with that many indicators. So we simply say when all of you turn into a buy, change the color of the candle. Now, what we're looking for is green if we're in a reversal, and we got a green arrow and a green painted candle, all right? Over here we have what are called PAT-Os. These are oscillators that we created, and we found out that they're really great on one chart, but they're not really great unless you have multiple charts showing the same thing. So this one over here is a 3-minute chart. This one right in the middle is a 7-minute chart, and this one down here is a 30-minute chart. Now, when all three of these point up, you can be sure that the reversal is underway. Now, why do we have a 3 and a 7? It's because the big boys, the scalpers at the big boy level, all trade the 3 and the 7-minute chart. And 10% of the market at any given time is made up of scalpers. And scalpers, unless they are going with the big boys, the market will go sideways as they continuously put trades in against the big boys. So we have to have the 3 and the 7 with us. We have to have the 30. We have to have the 15. We have to have the 60. All right. Once we have all that, you can see how easy it is to make a buy. This is green and green, 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 green. Everything's green. Now, down here is a 3-minute chart, which allows us to dial in our entries. And if we miss the first one, we're going to get multiple opportunities to enter into this trade, because each one of these arrows and painted candles are pulses of money coming into the market. You're literally looking at the big boys pulsing their money into the buy right in here. All right, let's take a look at another one here. All right, and we'll start this one from start to scratch. All right, so here we have, we've had a very strong move moving up, and we're looking at the wild card screen, and we now have this candle entering into the desert. What is the desert? It's the space between all the moving averages, okay? So the highest moving average is right up here on the top, and the lowest moving average is here. This whole area we call the desert. It is difficult trading. It doesn't mean that there aren't great trades in here. There are fantastic trades in here, but what it requires is much more confirmation. And so our 6 aces is designed to do that. So once we know we've entered into the real estate of the desert, we then simply turn over to the six aces on that currency. Now what we're looking for is harmony. All right, so here's the 240 chart. You can see that the candle over there on the right hand side is bright red as the initial pulses of the reversal take place. Okay, you can see that we have 1 HMI bright red. Okay, so we've got some horsepower at the 240 level. And then we look above north here and we see the 60. The 60 has red candles and 2 HMIs, indicating at the 60-minute level we have lots of horsepower driving this currency, all right, down. All right, we look over here and we see that the 3-minute is down. You'll notice that the times, I've drawn these lines so you can see the times where they are on the same date. So it's, you know, it's just real stuff, okay? So the 3-minute turns over at 424. The 7 had turned over at well below 416, but that's 416. At 4 o'clock, the 30-minute had turned over, okay? Now, over here we get an arrow and a painted candle. The arrow tells us money is coming in. The painted candle tells us that the 24 indicators have turned into a sell. So we can see that everything on this chart, from a 3-minute all the way to the 240, says you're a seller. So now we just simply go down here and we catch that market right at 424, which is when this 3-minute chart went over. That's this little pad O. At 424, you got your arrow and painted candle as the big boys threw some money in. That would have been your first entry. Now, what about making re-entries? That gives you the confidence to push the trigger on the first trade. All right. Now, that's a 75 pip movement right there through the desert. You'll see it come up in just a second here. There it is. So it has moved 75 pips from that candle straight down. Notice that right here, it's stalled at the T30. Then it goes to the next T30. And then it makes a valiant effort to try to get to the next T30, but can't quite get there. It gets within, 5-6 pips of it. That's it. That's a 75 pip move, all right, from that whole thing. So let's take a look here on the 3-minute chart on this same exact trade. Everything is exactly correct. From that, you'll see that I've marked the 424 in the morning candle. There's the 424 candle. So we have lots of opportunities if we're not in front of it when that first one happens. All right. So there's the first one. If you're lucky enough to get that one, fantastic. Okay. But if you miss it, there's your second one. It shows up. All right. Then we get our third one, opportunity. All right, now we get our fourth one. Now this one we're pass on. And the reason that we're going to pass on this trade is because it is too close to the T30 here. And because of that, we can't be assured that we can pay the man and make profit to that line. So we'll pass on this trade, but we'll manage what we got. But
nevertheless, money came in a sell. That's why there's an arrow and a painted candle there. Then we get another opportunity on the break of this T30 right here. Once again, we get another one right down here, and this one, once again, we'll pass on. Why? It is too close to the T30. Remember, there's 30 pips between each one of these horizontal lines. Your job is to get one of these and as many more as you can every day. We have a saying at our company, a T30 a day keeps the job away. And all you have to do is get from that line to that line, and you can keep the job away. Now, we have multiple opportunities to get more than that, but if you can just get that one every day, you're going to be absolutely tickled pink, okay? Now, we need to know where the big boys are going. So we have a tool we call the HSI, and I'm going to pop it up here, and I'm just going to pull up a chart, and let's go over here to the British pound, and I'm going to scroll up to a 60-minute chart here, and I'm just going to pop it back here, a couple right here. Let's go back to this big move down here, okay? All right. So once we have a top in place where we can see a top, all right? That's why I'm on a 60-minute chart. Once we see we have a top in place, all we simply have to do is use the HSI tool. Now, what is the HSI tool? It is a tool that has built in it Fibonacci's. Most of you use Fibonacci's. It also has previous support and resistance built into it. It also has historical movements of the currency. And all we have to find is a top or a bottom. There's nothing wrong with HSI's, but with Fibonacci's, but it's already built in here. Once we have a top, we tell it we're a seller, we click on the top, and we click it. And we can see very quickly that here, I'm going to make these bigger so you can see them, that the currency knows exactly where these are. These are the supports as it goes down. Here's the S3, the S4, the S5, and it makes a try to get to the S6, and it can on that first run, goes sideways, and it comes all the way down here to the S7, the 7th support, and it's headed down to the S8, and how far it gets almost all the way down to there, and it just misses it by about 30 pips right there. All right. Now, once we get down here to the bottom and we see that we have a bottom in place, we simply reverse that. And I'm going to remove this off of here, and we'll start all over again. This time we take the HSI tool. Once you have a bottom or a top in place, you simply click on that bottom. Now we tell it we're a buyer, and we're headed up. And notice how that movement went right to the R5, stopped dead. Do you think they didn't know where that line was? They knew exactly where that line was. And they retraced back off it, right back up to the R4, come back up. Now we make another move. Notice right in here, right to the R5, and it goes sideways, okay? And I'm on a 60-minute chart. So for 3 hours, it went sideways on that line right there. And then it finally breaks, and where does it go? Up here to the R5. Notice right here, for 3 hours, it did exactly the same thing. It stopped at the R6. Well, we knew this target as soon as we had the bottom. We don't have to guess at where they're trying to go. We know where they're trying to go. And our job, once we get a trade, is to try to stay in to that target. And these are a heck of a lot more than 5 to 8 pips. In fact, the movement from here to here is probably 200 pips right in this range right in here. All right? So, and you will notice, and the more you use them, the more you realize how much they respect these lines. Why? Because the Fibonacci's and all the stuff that they do is built in to that tool. So you don't have to guess, do I have the right top or the right bottom? Do I have any of that kind of stuff? Notice once that line we put on the bottom is right there. And up they go, and they stop dead right there at the R8. Right there. That's the 8th resistance from that bottom. And you know it from the very start. As soon as you have a top or a bottom, you know exactly where they're trying to go. Let's pull up another currency. Let's try the euro here, since everybody trades the euro. Okay, I'll flip it to a 60-minute chart. All right, and just take a second. We can see that we have a top up here. Okay, so we're going down. Let's see if we can spot where this was going. All I'm doing is clicking the HSI tool and clicking on that yellow line. That's the purpose of the yellow line, is to show you where the top is. And you hit sell, and once again, do you think they knew where the S1 was, the first support? Do you think they knew where the second support was? Right there. They knew exactly where the third support was. They reversed right off it and pulled back. Okay, this time they go like crazy, and this is more than likely, this big candle in the middle here is more than likely a fundamental announcement, but they went right down to the S5 and stopped dead right on the S5. Now we knew these targets once we had this top. There's no guesswork for us. We already know where they're trying to go. Okay, the tool has it built in. You don't have to be any smarter than find a top or find a bottom. Nothing complicated here. Okay, let's take a look over here at the CAD. Okay, so you know, the CAD's been going up here, so let's just pop it here, and you know, let's do this little mark right here from here. So you can see that we have a bottom right here. All right, so I'm just going to click on there, tell it I'm a buyer. All right. And there it tells me exactly where the resistances are as they go up. And you can see at the R1 they stopped. They blew through the R2 and right to the R3 and stopped once, twice, 3, 4 times. 4 times they stopped right here on the R3. Why? Because that is an algorithm, a mathematical equation that every single big boy uses. And so we use it, all right? And up they go, and they get within, you know, 5 pips of the R4, okay? So that's where they were trying to go, was that R4. Did they ever take it out? No, not yet, okay? So if this is still an uptrend, we still have the R4 ahead of us to target, and we now have the R5. Now what that does for us is, since we now have a valid target that we know where we're going, we can now quantify our risk and reward. Okay, once we know that this is the target, wherever we get our buy down here tells us how far it is to the reward. And then it's very simple to decide whether you want to put the risk on. Find the previous support, and that'll give you how much pips it is down here. And if you need at least a 1-to-1 ratio, hopefully a 1-to-2 ratio or 1-to-3, but 1-to-1 is the minimum. And if you've got to risk 45 pips here, all right, to make this trade, you can see right here that line is 1, 2, 3, and a few more. So each one of these lines is a T30. So that means that's over 90 pips away to that target right there. So if I had to put a 45 pip stop on here, I would still be risking 1 for 2, and I can make that trade very easily. Okay, very easily. All right, so you can see that, and that's built in. You don't have to figure it out. You don't have to learn anything about it or any of that kind of stuff. It's already built into the charts. So that brings me to the next question, which is, what is the safest ProAct trade? And the safest ProAct trade is very simple. Once we have a top or a bottom in place, we simply use the HSI tool, and we find the top and we put the targets on here. The safest ProAct trade is the trade between the S2 and the S3. In fact, it almost always just goes right to it, right? The reason for that is multiple. One of them is here, first of all, you can see that we broke through the moving averages. That was a real key. We now have more sellers than buyers. But the space between the S1 and S2 is very hard to make the trade. And this is the area where most traders lose their money, in the S1, S2, right? Well, first of all, they're trying to pick a top. That's number one. Nobody knows for sure if that's the top until after they build this, okay? Number two, once they have established that that is the top, the space between the S1 and the S2 is so small that the big boys can't make the trade. The big boys can't make that trade. Why? Because there's not enough risk and reward for them when they have to put $1 billion down. So they have a hard time making the trade from the S1 to the S2. But the S2 to the S3 is a no-brainer because they now have reward for risk on that one. And you can see that's exactly what they did. And then, of course, they went from the S3 to the S4 down here. Let's take a look at another one here. Here's an up move. And in this up move, I'll wait till it shows up on your screen here. Okay, in this up move, I simply found the bottom, put the HSI targets on here, and I block out the R1 and R2. Why? Because the currency has a hard time getting out of the R1, R2. Why? Because first of all, there's a lot of dumb money still selling this currency, even though the big boys are into the buy. We're below the moving averages, so we don't know that if we have more buyers than sellers. This is a big desert area here, all right? But you can see once they broke out of the R2, they just kind of meandered right up to the R3 without any problem, and that's better than 50 pips. And you'll get a couple of those every day, okay? Let's take a look at another one here. And this time I've got the British pound on here. And once again, all I did was find the bottom with the HSI tool, and that gives me my resistances headed up. I've blocked off the R1, R2, which tells me be careful in here. If you even want to make a trade, be very careful because they have a hard time getting out of it. And you can see how hard it is to try to get out of this area right in here, okay? But as soon as they make the break, look what we get. We get a dot, white dot, which tells us the big boys just put their trade in on the buy at the 60-minute level. We already have an arrow and a painted candle. We are in the desert, so we'd have to trade this with the 6 aces. But you can see they had no trouble going right to the R3, and then they continued right up and right to the R5 and stopped dead right at the R5. And we typically get our pullbacks at the R3, and we get our reversals at the R5. All right. If we're going down, we get our pullbacks at the S3 and we get our reversals at the S5. That's very typical on most currencies with the exception of the pound yen. All right, here's the euro yen. Once again, very same thing. What is the safest trade? All right. So once again, we found a top here. We simply put the HSIs on here, which gives us the supports headed down. All right. And you can see the space between the S2 and the S3, the currency made that in no time flat, just without a problem, went right down to it. And then it pulls back up into the R1, R2. Okay, that's this area. And this is a difficult area here, okay? But if we don't get it breaking out the other side, in other words, it doesn't break this top and continue on up, then we know these targets are still good because they're using these targets, okay? That gives us the opportunity to make this trade right here. On the next break of the S2, we make that trade. We've already taken the S3 out, so now we go down right to the S4, and it stops, stalls out for about an hour and a half, 2 hours, and then it continues on down to the S5 and a little bit further. So you can see while we stress staying in until the targets are hit. And the reality of this situation is, folks, the reason that most people fail in the forex is because they don't know where the currency's going. And since they don't know where the currency's going, they click out for a measly 5 to 8 pips because they look on their broker station and say, man, I could put 50 bucks or 80 bucks in my account right now. And so they think they're a winner when they click that 5 to 8 pip trade into their account, and they won the battle, but they just lost the war. Because now you must be right 90% of the time for the rest of your life. And that's not feasible or probable in the forex or any other trading institution. All right, so let's take a look at the royal flush here now. Remember, now the royal flush is the best hand in poker, and it's the best trade that we have. So I'm going to pop it up here. And it's a totally different setup. It's designed to trade for 150, 200, 300 pips. It's the trade that our traders use if they have to work a 9 to 5. They use the royal flush. They get into the trade before they go to work, and they go to work, and when they come back, their job is to simply move their stop on the trade they made this morning. Over on the right-hand side, in the center, I should say, we have a wild card, exactly like we've already seen it. Okay, it's no different from the one you've got there. All right, and the wild card, as you can see on this illustration here, we have a dot telling us at the 60-minute level the big boys just came in. We now get our arrow and painted candle. We're above the moving averages, and so we know we have more buyers than sellers. But when we look over here, we see now that we have multiple charts showing harmony, okay? We have a 5-minute chart with an HMI, that's the momentum indicator, plus the PAT-O. We have a 30-minute chart with a momentum indicator, plus the PAT-O, that's an oscillator. We have a 240 chart with an HMI and a PAT-O, and we have another 240 chart with an HMI and a PAT-O. Why do we have two 240-minute charts here? We're looking at different math to see how sustainable this trade is. And a trade that goes 200 to 300 pips is going to have, if it's going up, all of this will be green like you're looking at, plus the wild card over here. If it's going down, it's all going to be red. So let's take a look at one that's going down. I'll let the chart show up on your screen for you, okay? So once again, in the center of the chart, we have a wild card. That tells us whether there's any momentum, all right? We can see once again, we got our arrow right here at the top, right at the top of the move. We're out of the moving averages. We got an arrow and a painted candle, so that would be our entry. We also had a moving average right on the same candle, all right? When we look over here, we can see that what we got is exactly the same. Now the 5-minute, you can see the 5-minute just turned up based on these candles down here at the bottom, that's all. But everything else in this currency is absolutely headed down. And this trade right here is about 210 pips right there. And remember, this is a 10-minute chart, so that took about 2 hours, no more than that, maybe 2.5 hours to go 210 pips. And you've been able to stay in that trade because everything on this chart is telling you stay in this trade. Stay in this trade. Momentum is down. Don't click it out for 5 or 10 pips. Stay in the trade. So it's extremely visual, right? Do you need to know the math? No, absolutely. In fact, we don't teach you the math. All we want you to do is line up the colors. If it's red, it's going down. If it's green, it's going up. All right? So let's take a look at the 240 chart on the Royal Flush Live because it's a very different chart and it's going to give you the opportunity to see lots of stuff. So I'm going to pull this out of here and I'm going to head over. Yeah, let's go to here to the New Zealand here since it's we're in the market here. The yens are not moving, so let's just take a look at the New Zealand right here. This is live. All right, so we'll let it propagate here for a second, and we can see over here on the right-hand side, here's the candlesticks over here, and you can see we are in a state of disharmony. All right, here down here on this 240, we have red candles going down and a red HMI, but on this 240, it's going up. And the result of that is the currency is going sideways. The 30-minute is trying to push down, but the 5 is going up. There's no harmony in this chart at all whatsoever. But I'm going to pull this one up here, the 240, nice and big where you can see it. Now, on this chart, there are lots of different things happening here. First of all, when you look at the chart, you'll see that we have moving averages, and we can see that they change color. When you're above the moving average, they're green. And when you're below the moving average, they're red. Okay, very simple. I'm going to make this pretty big so we can see the whole thing here. All right. You'll also see these big black candles. We call them blackjacks. I wonder why. We use the poker theme. All right. These are blackjacks, and blackjacks are heads up. You first get a diamond, and then you get a blackjack. Now, if the blackjack does not have enough stamina to turn the moving average from red to green, then it's a cause of caution. But if it does have, like for instance here the black one turns over here on the left, the black one hits down here, and you can see the moving average right after that, right underneath there, turns bright red. All right, that's a visual sign that this currency has the power to drive this thing down. Now I'm going to pull up my little marker on here because I want to show you a couple of things that are really important to see. And remember, this is a very visual, our business is very, very visual. There are no sustained moves in the currency without the HMI being with it. So you can look up here and you can see the HMI tells you you have momentum going down. Remember, we are momentum traders. We don't get snookered by price. We want to see momentum. We need the big boys in the market. And if we have an HMI, that's important. Now, the moving average has turned red. We have a dot here telling, a diamond over the top telling us that the big boys are driving the currency down. We have a blackjack, which tells you you may have enough power to break through this moving average. Now, the next thing we have is when the currency is trending, you'll notice that going down, there are no wicks on the top of these candles going down. You'll look over here and you'll see that when we have this upward move, and we're on the New Zealand, it's not exactly a rocker here, okay, but we'll see here that when we have the blackjack above it on here telling us heads up, momentum is changing, and notice going up we have the HMIs, black is neutral, green means we got horsepower in the market, and right here on the bottom of the there are no wicks going up. That tells you you are trending. Coming over here, where we look at this one right here, all right? You see you had the blackjack that told you ahead of time it has enough stamina to turn the moving average red, okay, telling you have more sellers than buyers. And now we have momentum in the market driving it down, and there are no wicks on the top coming down. It is your key to do two things. Either find a trade here, number one, or number two, if you're already in a trade, maybe you entered this trade on a 6 aces or a wild card, but when you look at this royal flush, you say there are no wicks on this thing. That's the time to pull your stop back a little bit and let this baby run. Kind of like trout fishing. Don't try to yank the trout in right away. Let it play itself out. Same kind of thing here. Don't be in a hurry to move your stop in a currency that is trending like this. So this chart is full of information that can really help you to stay in your trades. And remember, if you can learn to trade for 55 pips or more, you will be able to only trade, have to only be right 40% of the time. In other words, you don't have to be the greatest trader who ever lived. You can be a mediocre trader and still show success. All right? So this is a very, very different chart, and it's full of information. Okay. Well, one other thing while I'm on this one right here. If you find that you have areas, let me mark, we call these gang fights. All right. Not one of us would go into currency and say, you know, I tell you what, there's a gang fight going across the street. I think I want to jump in it. When you have wicks on both sides of the candles, that's a gang fight. In other words, the bulls are duking it out with the bears to see who's going to win. All right, the bulls won in this case. But during this period of time, these wicks will take your margin. And during this period of time is a time you want to be out of this currency, not in this currency. So it's very important because it's very easy to see. All right. So let me run back here to the PowerPoint. All right. Now, we tell traders to trade for 55 pips. When you enter your first trade at market open, whenever that occurs, if you're trading the London or the US or the Asian market, when you get your first trade of that session, you want to put a limit of 55 pips on it. And I'm going to show you why. Okay. And so let's just take a look here. I'm going to go to the wild card, and let's take a look at the pound first here. All right. Now, here's the wild card this morning. You see it, I marked it here. So you got an arrow. I mean, you got the white dot right in the center. You got an arrow and a painted candle, okay? Now, that would be your first trade at 4 o'clock in the morning. Down in here, there's nothing, okay? There's nothing here. Well, you wouldn't even have a trade because you'd have to break the rules. So the first trade of the day comes at 4:10 this morning. Okay, this is happened today. All right. When we get our first trade, we have a little tool called the PAT projector. We click on it. We click on the bottom of this candle. And I have mine preset to show me where a 30 pip stop is and a 55 pip limit. And you click and you're a buyer. You tell it, I want you to see where they exited. That's 55 pips. That market went exactly 55 pips, and they sold off their first position. Why? Bankers go 55 pips. They then sell off half their position and move the rest to break even. All right. Now, we get another pulse of energy in the market here at 7 o'clock in the morning. Now, I'm Central Time, so that's 8 o'clock in the morning, okay? At 8 o'clock this morning, we get another pulse as the big boys come in, all right? Let's just see how far they go. Here, I'm clicking right on the bottom of this candle, and I'm telling it I'm a buyer, 55 pip limit and 30 pip stop. Notice where that candle stopped, exactly 55 pips to the pip, because that's what big boys do. All right. Now the key is you have to know to get this candle, and the only way you know to get this candle is it's got to turn bright green or bright red if you're going down with an arrow and be above the moving averages. If that doesn't occur, then you won't know. You can't take the trade on our trade, but it doesn't even show up on other charts because you got to guess which one of these candles it is. All right. We're taking the candle that the big boys are putting their money in. You're actually seeing it, and at 55 pips, they exit their trade. So, you know, then, oh, here's another one right here. There's a pulse right here. More money came in. Let's just see what this one is. I'm going to click right here in the bottom. All right. And it gives me a very visual. Now, I don't trade. This is not how I make a trade. This is how I put it on the chart so I know how to stay in. All right. So from here, my stop would have been here. There's 55 pips. Look where they went. 55 pips, a couple of pips above it, and a reverse right off of it. So there were three 55 pip trades on the pound dollar this morning. All right. And that all occurred prior to 10 o'clock this morning. So from 4 o'clock to 10 o'clock, the 165 pips that you could have pulled out of that trade and seen them exactly how they come and been able to make those trades because it's extremely visual for us. Let's take a look at let's look at the Canadian, see what we had over here. Okay. All right. So here's the Canadian, and let me see here. Let me auto scale this here. All right. So here we got a trade coming down. Okay, through the desert. Let me take everything off of here so we don't. Let me just. All right, so we have a blank chart, okay? So here's our pulse up this morning right here. There's the arrow and the painted candle. Now this one is a trade we would not have made, okay? But I want you, my point is to show you that they're going 55 pips. Once again, I click on the PAT projector. It's a buyer, and look where they went. 55 pips right to there, all right? Coming down this morning, you would have had this trade right in here. That's a trade in the desert. There's the moving averages, so you're in between the moving averages. So you would have clicked on that trade and you would have made it on the 6 aces. But you would have clicked right there and you would have told you were a seller, and your job would be to stay right to that line right there, and that was 55 pips from right there to there. That's what we tell you. The key is you got to be able to get that candle. If you can't get that candle, you don't know where it is. You're guessing which one of these candles you ought to put it in on. But we are actually measuring the momentum coming in the market. We're seeing the big boys come in right there. And that's how we know they're going 55 pips from this point right there. So that's how that works. All right, so ProAct charts are like a roadmap, okay? We give you a start, and then there's the finish. All right? It's just like a roadmap. It tells you where the targets are, and it tells you where the big boys started. That's the whole key. It's momentum. The key to trading with us is we find momentum. Nobody else on the planet can find momentum like we are. Why can't they find momentum? Everybody's trying to chase volume. You cannot find volume in the forex because we have no central location for all the trades to clear. New York can tell you exactly how many shares changed hands today at the New York Stock Exchange. Why? Because they all cleared at Wall Street. Well, we can't do that in the forex. So we went after momentum. All of our stuff is designed to find momentum. When are the big boys coming in? So we also believe in free training. Every Tuesday night and every Thursday night we have free training calls. They're live in the market. Bi-weekly, we do an advanced webinar. That's on Wednesday night, the in-between night on the Tuesday and Thursday. It's a live call. We have free tutorials on our website that teach you these setups using these charts. We have a live trading room every day during the New York session that's run by one of our mentors, a certified mentor who walks people through these trades, okay? We have a free 2-week demo, but on the demo you only get 2 currencies. You get the US dollar Swiss franc and the pound Swiss. And that's because there are 4 setups. There's another setup which is a reversal setup, which we don't have time to show you. But there are 4 trade setups that allow you to trade whether you're a swing trader, an intraday trader, a momentum trader, or a reversal trader. Any one of those, we have trade setups that are built in that are high probability, extremely visual, and most importantly, they have black and white rules. It is this plus this plus this equals a trade. There's no in between, there's no gray area. It either is or it isn't. So if you can't follow rules, then first of all, you shouldn't be trading. But if you can't follow rules, then you will have trouble. But if you can follow rules, then you have a very, very high probability of success. So what does it cost to use the greatest charts in the world? That's the next question. All right. So our charts are $200 a month. And that's only 50 pips a week on a 1-lot mini, or 2 trades a week to a T30. Remember, a T30 is a 30 pip interim target. And you get multiples of those per day off of every single currency. And all you got to do is find 2. And you've paid for the charts. There is a $100 activation fee. However, I've got a deal for you. There is no contract. It's month to month, okay? We include two data feeds. One of them is FXCM. Why do we have FXCM? Because FXCM is the largest broker in the world. Now, FXCM has a very slow feed, so therefore we have to provide a feed that matches the broker, and that feed is very slow. So we have two data feeds